Let's get into the technicals now. Tony Sycamore from IG joins me. Tony, I want to have a look at the Aussie dollar first because, as I mentioned at the top, it does really seem that the messaging from the RBA is a bit confusing when you look at the somewhat calm tone in the media statement versus how hawkish the governor was at the press conference.
My initial thoughts when I read the statement was this wasn't a central bank with the hand poised over the rate hike button. But obviously the tone of the press conference was more hawkish. And I guess what it does do is it reinforces the idea that they're going to be looking very closely at the incoming data, employment, inflation data, particularly that quarter four inflation data, which hits at the end of January, to make the decision with regards to February. And what that's done for the Aussie dollar, it's been this shift in rate expectations has continued. We've now got almost 2 rate hikes priced for 2026 from the RBA, whereas 3 weeks ago, we were still pricing in a small chance of a rate cut. And that shift in rate cut expectations in the Australian rates market versus the expectations of the Fed to continue cutting rates is providing a powerful force for the Aussie dollar. And it's up about 3.5% in just under 3 weeks. Now, where it goes from here, I think it will probably head up towards the top of that trend channel. But you can see there on the daily chart, it is certainly overbought. So I'd like to see it do some more work around this 66.50 area, potentially pulling back. And if you do get a pullback, for me, given the fact that risk assets seem well supported, given the fact that commodity prices are still doing really well, we saw new highs in silver overnight. Obviously, copper doing very, very well. Also, iron ore holding above $100. I think that gives the Aussie the incentive to break through the 66.50 area and trade up towards that September high we saw there at 67.06.
Do some work, as you say, around the 66.5. Get to it. All right, is the market doing enough work, the Aussie market?
The Aussie market doesn't like this shift in rate cut expectations, that's for sure. And you can see that the bounce from the lows there at the end of November has been somewhat tepid for good reason there. We are a very interest rate sensitive stock market here in Australia. Nonetheless, by the end of this week, we come into the seasonally bullish part of the year. We've got now more time to digest what the RBA has said, but we still have about 2 months left before the next RBA meeting. So I think with that in mind, the seasonal's playing out that you can see the ASX 200 push up towards 8,800 into year end. And then we start to look at that data, which begins to flow in the second week of January.
All right, let's have a look then at what we're seeing with the Nasdaq, because it was pretty much the only market that was higher on Wall Street, although marginally last night.
A cautious session on Wall Street, a second cautious session. And that makes sense. You know, we have got one big central meeting to go tomorrow morning. And I guess if you're one of the hawks on the FOMC board, you're probably not feeling any better about a rate cut tomorrow, given the strong JOLTS job openings data, which we saw overnight. While that didn't change pricing at the front end of the rate curve, we're still about 87% price for a rate cut tomorrow. The march in US yields has continued overnight, and that is starting to become more unrelenting. We're seeing it here in Australia, New Zealand, Canada, Europe, and it does sort of play a bit of a role into how far these markets can bounce into year end. Nonetheless, I do expect that Nasdaq, as you mentioned, it was the only one higher overnight. I think it can take out that 26,182 high there and head up towards 27,000 into year end. And that's just providing it holds above that yellow line, which was around 24,000, which I think is now where you would have to reassess that bullish view.
All right, we continue to monitor what's happening with Russia and Ukraine. A little bit of pressure coming through on oil.
Yeah, I mean, it's in 2 sessions. It's given up almost 2 weeks of gains. It's been a very dramatic repricing lower. And, you know, we've still got concerns around supply. The inventories data tomorrow in the US, particularly gasoline, is probably going to see a 4th consecutive week of rises there, of rising inventories. We are coming into the Northern Hemisphere winter there, which does sort of weigh on demand, weigh on demand, as I said. And what that means is crude oil still has its eyes on this very important support coming in around $55. Now, if it were to break that low, then I think it's probably the green light to trade down towards $50. It's got to remain above there. So it is very, very important. And I think into year end, we can hold above there. But after that, we'll just have to wait and see.
All right. And what are we seeing with Bitcoin?
Bitcoin was interesting yesterday. For the first time in a while, it disconnected from risk assets. So we saw US equities finish lower, but Bitcoin actually finished higher overnight. And that was also despite the move higher in yields. which generally are headwinds for Bitcoin. So I think the fact that we've had a good session overnight, that session was sown the previous night. And what I'm seeing here in the Bitcoin chart is, when we saw that capitulation low at 80,000, we thought it would trade up towards 95,000, possibly up towards 100,000 for a counter trend bounce. And that is what I still continue to see this bounce is playing out as, a counter trend bounce. So I would need to see Bitcoin get above 95,000 to 100,000, which is the resistance area, to really negate that view and to suggest that we can have a stronger rally in 2026. But at this point of time, the bounce is playing out largely as expected. I'd be looking for a turn lower somewhere from this 95 to 100K level in the sessions ahead.